Alrighty, let's go ahead and get started. Welcome everyone to TradeFinder Live. It's great to be back with you all during this trading day and during trading hours. First and foremost, as always, we do have to cover our disclosure disclaimer agreement. The main thing to take away from this is that we are not licensed investment advisors in the United States, so nothing's to be taken as personal investment advice. This is always available on our website to be read in full detail at your leisure, or feel free to take a screenshot of it now if you like, but that's the main point to take away. Have lots of exciting topics to get into for today's session. This morning, the headlines were, will China actually want NVIDIA's more advanced H200 AI chips as Trump's approved the sale of those chips to China. And I know Jensen Yang was excited about the new technology that they have, but of course, the underlying question is, will China actually be interested in investing? So that'll be interesting to see how that plays out for that stock. Another big headline that caught my eye was that Trump officials moved to end student loan payment pause for millions of borrowers. So that's another interesting topic that seems to have major implications in the market. And overall, no, with the Fed tomorrow, does anything else really matter? That's when I think when all these questions will be answered, and we'll have a lot more to talk about there. So I'll stop rambling on and let the expert get to it. Rob, how you doing?
Good, Zach. How are you? Sound better than yesterday. For those not aware, Zach spent his weekend in the hospital and had a procedure Sunday night and still managed to make his EWO Trader Live scheduled performance yesterday. So appreciate you being here and glad to hear that you're sounding better. Hopefully, well on the way to mending. Go ahead and turn the video on. A couple of comments that you brought up that I thought would be interesting to talk about. NVIDIA, I imagine we'll be looking at that chart and somebody will ask about it, or maybe not, because y'all haven't asked about NVIDIA as much lately. But isn't it interesting, the question you posed? Now it's approved for NVIDIA to sell their chips. I did watch this special on NVIDIA yesterday, and and you got to take it with a grain of salt. And my viewpoint on the analysts saying that they think NVIDIA goes significantly higher even without China. We'll see. That's actually one of the subjects we're going to be talking about tomorrow night. I'd like to invite everyone to our Focus 2026 market outlook for next year that we'll be doing tomorrow night at 8 p.m. Eastern Time. It's free. Do an outlook each year, but we haven't always done these broadcasts. But thought that maybe there'd be some interest in where we thought things may go next year. So if you're interested in that, there's a lot of tidbits, done a lot of research putting this together. So a lot of good information, regardless of whether you care about my outlook for the year or not. So lots of reasons to attend is my point. So I'll ask Zach to put that link in the chat box. And again, it's free. Sign up. And as a reminder, if you can't make the live event, no worries. You can get the recording of it. So not a requirement to attend live, but we will do a Q&A at the end. So if you would like to participate in that, then you want to be in the live event, completely up to you. So with that, let's take a look at the charts. Interesting comment you made about the student loan thing, Zach, and people may wonder why that matters. Well, it's consumer purchasing power, and this is affecting the age group that spends a lot of money. A lot of companies market that age group that have just recently gotten out of college, getting their jobs, starting to buy houses, do other things. So if they don't have as much spending power because they're paying back their student loans, then yeah, it can affect consumer spending and therefore where the markets go. All good talking points for me. It's all about the Fed tomorrow. Not as far as if they cut the 25 basis points, that's expected. It's if they surprise and don't cut. That could be wild. And when we get to the bond market, you'll see that, yeah, it's a little bit of a tenuous time here. More things to talk about tomorrow night. As far as the markets, we're testing that wave three high. This is actually good performance right here. You may wonder, is it a bad thing that we haven't broken that wave three high yet? especially with this wave four still being labeled green, meaning it's still active. The algorithm, even with this rally, is not quite convinced that that's it, that that's the end of the wave four retracement. And boy, wouldn't the markets likely pull back if the Fed doesn't cut tomorrow. That would be a surprise. The expectation is that they will, and the Fed fund futures are saying that they will. But back to the resistance, I've talked about this so many times in the past. We did have this big run up. It ran up starting last week or 2 weeks ago, however, time goes by so fast during the Thanksgiving holiday shortened week where volumes were down. You can see when I put the volume underlay on that we had there was the declining volume. And normally you get a quick retracement when you go through a holiday shortened week. We did, but talk about quick. It was very quick. It was basically on the open on Monday, right there last week. And so we had a real quick, it's a trade that I like to do when we have a low volume rise or a vertical move. It's a 1 to 3 day, sometimes only 1 day trade. In this one, it was literally a few hours before the market started to rally. We did come back and get down near the low at the close. So you could have stayed in the trade the entire day and made just about as much, just 5%. Not a big deal. But if we could do 5% a day, I think everybody would be happy. So just little things that we can do here and there in addition to looking for positions for directional or sideways movement. Our focus, by the way, tomorrow night will be more on directional. I know that's what everybody likes. That's where you can make more money being right on direction. So we'll be focusing on that tomorrow night. So this consolidation underneath resistance, I view as a positive. Maybe the market is just waiting just for the confirmation that the Fed does cut. Most people are expecting what's known as a hawkish rate cut, meaning that they're going to cut and then say, all right, we did this second cut. Now we're going to wait for a while. We're going to go back to that data dependency they talk about all the time and not make any sort of a commitment at all for when the next rate cut may occur. So that's the expectation. We'll see what actually transpires. But consolidating before you break resistance gives you a better chance of that break holding and continuing higher. Up possibility to a wave five. There is no wave five tap box labeled yet because the wave four is still viewed as being active. If we do break that wave three high, I think that will turn purple, which means that it's, we've been asking, what does that mean when it's green versus purple? It means that the algorithm views it that this is still active, not convinced that's enough of a pullback. But if it turns purple, then the algorithm has found enough data that it feels like, okay, that was the low for the wave four correction, and now we've proceeded into the wave five high. So sometimes it does that before you break the wave three, which is when you get confirmation that you're in a wave five. So the algorithm is wanting that confirmation, which means it's something we should keep in the back of our minds, in my opinion. Now let's get to the bond market, where I was talking about how it's been pretty wild. This move to the downside. Been talking about this a lot towards the end of last week and then the beginning of this week. This head and shoulders that we have on TLT. Remember, TLT is prices on the 20-year, prices and yields move inversely. So prices are going up, yields and rates are going down. So we have this big move to the downside here, breaking the neckline. And if you're not familiar with head and shoulders patterns, you have the left shoulder, the right shoulder. I like it when they're symmetrical like this. So it's pretty solid head and shoulders pattern. Never any guarantee of any pattern working, including head and shoulders. But if it does work, the expectation is once you break the neckline, you move down the same distance as there was from the neckline up to the top of the head. And that brings us down here. We do have a downward zigzag as well with a perfect 50% correction. Couldn't be more spot on there. And then heading down to the expectation of a 100% C wave extension. We're getting a little bit of a bounce in prices today. So yields taking a little bit of a break, but yields have been going up as prices have been going down. And then we move over to TNX, the 10-year. And again, as a reminder, this is rates on the 10-year. So rates moving up here in concert with the 20-year. and what liquidity was injected and then immediately taken right back out. If you watch the U.S. Market update on YouTube over the weekend, there was a tick up in um, money coming in, the monetary injection into the system, and then the Fed took it right back out. They say that they're going to inject liquidity now. Uh, they're going to have to show us, though, because so far they've just showed us a flip-flop. And we'll see where things go from here on yields. So when we go back to the TLT, it doesn't look like we're done with rates going up yet, at least on the longer end. And it is having an effect. Toll Brothers down today on the housing market. And I'm kind of opined the Fed with what liquidity they did inject was on the very short end of the curve, which did create a steepening in the curve, but it's artificial. When you have a steeper yield curve, in other words, rates are lower on the shorter end, higher on the longer end, which indicates a healthier economy, a healthier bond market. That's the way it's supposed to be. Pardon me. You're supposed to earn a higher rate for committing to hold a treasury or bond longer than a shorter term. And then you can get into the conspiracy side of things. Was the Fed doing that because they've been doing what everybody else has been, buying much shorter term maturities, taking the same interest rate, rolling it over, and then in the end, you compound the rate return faster than if you just commit to buy a longer bond or treasury for the duration on simple interest. So uh, difference between compounding and simple. So we'll see if that plays out, see what the Fed does. Lots to really think and focus on through the rest of the year. But the reason I came back is I wanted to show if we break this C wave on the TLT, the next level is down here at the 161.8% level, which coincides with some support from the summer and then as well as satisfying that head and shoulders. So reasons to believe that we may still go, even though we're getting a short-term bounce today. But a reminder, we were pretty separated from the 10-day moving average. This may just be a very short-term bounce on prices. And then going back to TNX, the expectation that it continues back up to the previous four. It's almost there. This wave five is ended. All these boxes are purple. So looking for a potential retracement there. Then what happens? Then we need to figure it out because that Elliott wave, um, five wave pattern is complete. You finish the wave five, you go through a corrective phase, and then you move back towards the previous four if the wave five didn't extend beyond 100%. If it extends beyond 100%, it's a different story. And we'll talk about all that. So a little bit wondering about rates moving up. Maybe that's just the bond market looking ahead and expecting that hawkish rate cut tomorrow, that we get the rate cut, but then they're not going to tell us about anything moving forward. And so rates already starting to move up based on that expectation. So many different possibilities, hard to know which one is which. Getting a little bit of support on the dollar, which kind of surprised has taken this long. We're still in the Goldilocks channel here. As you've heard, if you've been listening to TradeFinder or the market updates or any of my webinars, you've heard me talking about how I don't want to see the dollar go down too far. I don't want countries to start being concerned about whether they should continue to hold the dollar and absorb the losses. But I don't want it to go too high either, because then it affects earnings for companies with international exposure. We have global economies now, and that would most certainly come into play in the next quarterly earnings cycle of companies complaining about the exchange rate. We would hit our numbers if it wasn't for the exchange rate. We haven't had to worry about that. We're still in the Goldilocks channel here, but neither one of these wave C's and these two zigzags here have been hit yet in the dollar. And again, with the wave five being finished here, if we go all the way up and hit one of these C extensions, then likely going to that previous four, we're going to be so close. Why not? Wouldn't be that much more of a tick higher. So maybe some support in the dollar. I think we're okay, even if we go back to that wave four. But we start going higher than that, that's when I start getting concerned about the next quarterly earnings cycle and the exchange rates that may play in there. The VIX just still holding 15. Look at that. Came right down, touched 15, and then we bounced back up. We're still below the 10-day moving average, however, so just slightly elevation on the VIX, but it's maintained its stance. This past year, I came out with two main scenarios in my outlook for the year. One was that we would have more volatility this year, and we've had that with the fact that we never broke below significantly 15 on the VIX to go down to 12 and a half, where we spent the low as support all last year. But this year, still maintain that slightly elevated volatility position, at least as evidenced by the VIX. And now we have to wonder, all right, if we hold this 15 level, if the Fed disappointed, likely see a spike in the VIX. Are we going to see a spike in the VIX for other reasons that we haven't taken into account yet? Or are we going to have that end of the year rally? The Fed gives us what we want. They do start injecting liquidity, and we turn and we start moving back to the upside in the markets, which maybe that finally breaks below this really hard floor here at 15 on the VIX, and we move down to where the next support level would be, that 12 and a half level down here. So keep an eye on this 15 level is kind of the line in the sand, as you're aware by now, I would imagine. Looking at DIA to see if we can break to new highs. I have drawn the fib retracement here on the DIA since that wave 5 did extend more than 100%. Again, as a reminder, with Elliott wave rules, you then do not look for a retracement back to the previous 4. You look for a corrective move in that corrective phase following a wave 5 back to a fib level. And we went right to 38.2. And again, we're consolidating here above the 10-day moving average, right below the all-time highs. It's good action to consolidate here for an attempt to break higher with one that has some potential sustainability. We have these big rallies up like we did on the DIA through the Thanksgiving break. And as I was talking with the SPY, thought maybe we might retrace some of that. We didn't. We've held it pretty well on both the S&P and the Dow. A little bit of surprise to me, but it's very positive. You wouldn't want one of these resistance levels to be broken on a vertical move that started during the Thanksgiving holiday shortened week to break the resistance and move to new all-time highs, because that would have been too vertical of a move and likely wouldn't have held. This at least gives the opportunity for it to hold if we consolidate and then bust through those levels. Then we could see some renewed impulsive type moves higher from there. Looking at the Qs, there's a little bit of rotation, it seems, in the tech stocks. NVIDIA came out, had good earnings. It was just pretty amazing. That company, hard to bet against. NVIDIA, their valuation isn't in the same stratosphere as PLTR or some of the others. So pretty good place to be there. Not quite to the resistance of the previous highs, not as close on the Qs as we are on the DIA and the SPY, but still in the neighborhood, still above the 10-day moving average, still consolidating nicely the move that started. And I was talking about that lower volume, and some of you made some comments on the YouTube video over the weekend, which are true, that oftentimes new impulsive moves start on low volume. That is true. That's statistically true. However, for them to maintain and continue at some point in time, higher volume needs to kick in to support those breaks and continue that move higher. If we look at the IWM, just really just kind of blowing me away, the IWM, the one market that has taken out its recent highs. It took out today the high from October. So new all-time high, bounced off it just a little bit. And this one did not relabel the pattern. It just moved the wave 5 over, which is interesting, especially considering it has moved more than 100%. Again, don't expect the wave 4 to retrace. And look, we came back down here to that 50% corrective level, but now that's not the start of a new impulsive move. at least as the algorithm has labeled it, it's a continuation move. So this wasn't a wave five that ended, a move back to a fib level. It was a good 50% retracement of that wave five, but now the wave five continues. How far can it go? Well, it can go as high as it wants. It's just you start to get to areas where normally it doesn't continue. So that's really interesting. Probably the most interesting thing I see in the markets on this trading day. And then again, we wait and see what happens tomorrow. We might get a pretty wild afternoon tomorrow after the 2 p.m. announcement, 2 p.m. Eastern time from the Fed. But I've talked about the IWM, the Fed always talking about their dual mandate. They're supposed to watch employment and inflation. That's their two primary goals or objectives. And then I've talked about how the IWM gives you the possibility of two different correlations. Dual correlation is a phrase that I think applies to the IWM. The first one is rates, tends to move opposite of where rates are going. Rates are going down. That's usually supportive of the IWM, but rates have been going up and the IWM is still going up. So the second correlation is the market's tolerance for risk. And is the IWM the leader now? Is it showing that there's still an appetite for taking risk in the markets? Risk on, normally meaning markets move higher. So it has to be that one. There really is no question about it because rates themselves have been going up, and yet the Russell is moving up as well. And just if you're new, a quick reminder, the IWM is the most rate sensitive of all the markets. Small caps, small companies, a lot of companies in the Russell aren't even profitable. They have to borrow money to grow and expand their business, and they tend not to do that if the rates are higher. But maybe they are borrowing, thinking that rates are going higher, but they might go even higher from here. We're still at historically low rates, even though they've ticked up a bit. So really interesting there, seeing what's going on with the Russell today. If we go to the metals, GLD ticking higher, and this would make sense if the reason rates are going up is they are concerned, the bond market, meaning they are concerned about if the Fed does cut tomorrow and continues to inject liquidity, is inflation going to come back? The inflationary numbers that we got this week were okay. They really were. Or last week, end of last week, beginning of this week, all runs together. But the most recent inflationary data, still above where the Fed wants it, but not rocketing to the upside. But maybe the metals are thinking that could happen. There's a potential for gold to go a lot higher, as you can see here. We had this wave four right in the 38.2% corrective level, which could mean at least a 61.8% extension on this move in GLD. So it seems to want to continue higher. And then SLV over the recent couple of weeks, as you probably know, have been outpacing gold. We had this vertical move and an impressive consolidation following that move. We went too vertical. So we're too far from the 10-day moving average. You know the rule. No security any time frame gets too far from the 10-day moving average, at least not for long. Back to the 10-day moving average on a nice sideways consolidation, and then moving higher again today on silver. How far can that go? We are getting into the tap box now on silver. Maybe it leads for a while and then pauses and lets gold take over again. There's always the aspect of silver being so involved in technology these days. A lot of people argue the reason silver outperforms is because of that. But regardless, it's in an area where we should keep an eye on it, especially with today's move giving some separation from the 10-day moving average again. Still maintaining a bit of a vertical move, getting into an area where we may see some resistance. I think there will be a lot of action in the bond market and in the metals market after the Fed announcement tomorrow. I think that's coming. If we move to the crypto world, you've heard me talk about this, where We're in an area that needs to hold, and it's trying that 45 level, at least on the BITB, which is one of the Bitcoin ETFs, the one I like to look at because it has only monthly options, doesn't entice people to trade real short term, which I think is dangerous in the crypto space. But a lot of you like IBIT because it does have weekly options. Regardless, the monthlies are very liquid. The options are very liquid on the monthly options on both the BITB and IBIT. So where can we go from here? Well, we've broken above the 10-day moving average. We held 45, which we needed to. We had too much separation between the 10 and the 50-day moving average, indicating that at least a short-term bounce was in order. And I wouldn't be surprised to see this bounce continue, at least till BITB comes back to 55. That's where there was support. So old support becomes new resistance. You know the phrase. And it's also where the 50-day moving average is, which would bring the 10 and the 50-day closer together. Then I think is a different story. Then we kind of have to wait and see what happens from there. But look how we had this zigzag here, 50% B wave correction, 100% extension, kept going, went to the next fib level, touched it, the 161.8% extension, and then that was it. Happens so often in zigzags. So now, do we continue this little bit of a bounce? I think there's a chance for that. Same thing here in Ethereum. Pretty nice move here back to the upside. It's closer to its resistance level than BITB is. Same story though. Too much separation between the 10 and the 50. Had it to hold the level at 20. It did. So now we're back up and 25. Same thing, was support. Test that as resistance. There's where the 50-day moving average is. So these two charts are very similar between BITB and ETHW as far as maybe a little bit more to the upside, and then we have to wait and see. Then it becomes the Missouri thing. Then you have to show me that you can move higher. And if we can break through these levels, maybe we do get a crypto rally into the end of the year. I think that we need the Fed to follow through with what they said they were going to do, which is inject liquidity. They're going to have to do that. And if they do, then we can keep a bit, I think, under the crypto space. But for now, maybe a touch more of the upside, and then we have to wait and see where things go from here. Moving to energy, we had that big move up in UNG. Look where we went. So 50% B wave correction. I want to know why I love zigzags. Just look how often they work. Nothing works 100% of the time, but a 50% B wave correction right at the 50-day moving average gives you 100% extension expectation, exactly where we went on that big gap up, and now back down. So too vertical, too fast. What goes vertically up oftentimes comes vertically back down. I say these things over and over and over again because they work such a high percentage of the time, and regardless of what trading system you use, what technical analysis you use, those are rules for anybody's trading toolbox because they're just so good and they work. And zigzags, and I didn't, I proved this on my own. But this was in Eliot's works. If you read his writings, he loved zigzag patterns. So I think paying attention to zigzags is key. I love the zigzag tool that comes with the software. So now we have to wait and see what happens. I thought if we broke 15, we'd make it up to 17 and a half. We went there in one day, but now we're right back down again. So maybe we didn't miss it. It kind of was frustrating that we had that big gap up move and then run up to 17. As I said, that might be it. It may not make 17 and a half. That might have been the end of it. But it bears watching again, I think. And then we'll look for the same thing. Do we come back and break above 15 again? And maybe it doesn't do it in such a vertical manner so that we can actually participate in the move from 15 to possibly 17 and a half on that move. So weren't able to take advantage of that. Not going to chase a move like that. This is why You get a vertical gap up. This is what happens. So um, maybe we didn't miss it though. Maybe it gives us another chance with a more reasonable pattern of the break of 15 that we can actually trade to the upside. And then oil. This is one of the things that I talked about in the outlook for the beginning of this year. The first one was more volatility, and then the second one was, I believe, oil stays in a trading range, which it has. And we have back-to-back triangles here on the USO, and it looks like at this point, what we need to do is extend the triangle. I've talked about this before. There's no such thing as two false breakouts. When a triangle breaks out, you can break out and run. That's one way. You break out, test the breakout, and then run. And then the third one is you get a breakout, and it's a false breakout. And the big move is the other way. The market loves to give head fakes. It loves to try to trick the retail trader, in my opinion. It was my words. And if you get a move lower and then it breaks higher, and then that retraces. So it looks like two false breakouts. That doesn't happen. What it's telling you is that you have a larger triangle. It means that the triangle wasn't finished, and that's where I would draw the lines now. So we're back into oil could break either direction from here. I was a little surprised that we didn't continue this breakdown because over the Thanksgiving holiday weekend, OPEC came out and said they were going to maintain their current production levels. Remember, I've been opining because they increased production on these two spikes that we had in oil. And so as oil came back down, I've been wondering how low will OPEC let oil go before they cut production? And apparently they're willing to let it go even lower since they said, no, we're just going to maintain where we are. I think OPEC has been managing the supply demand curve pretty well. Think what you want about OPEC, but they have been doing a good job of managing that. They want to keep oil prices elevated. They don't want them to come too far down, but they don't want to chase everybody into electric vehicles by letting oil get too high. And I don't think they want to let oil get too low either. They want to keep it in that Goldilocks scenario, and they've done a pretty good job of it. It's maintained this range the entire year, just as I kind of thought it would. Couple of little aberrations here and there, but then right back towards this level between 70 and 75 has been that area that it's maintained. And we'll see what happens. This is likely going to break out. I always like to look at the ADX, as you know, for triangles, a low ADX. The ADX, if you're not familiar with it as an indicator, measures the strength of a move. So when the ADX is going up, that doesn't mean necessarily that whatever security you're looking at is going higher. It means whatever move is, if it's up or down, is gaining strength. So when the ADX is low, it's telling you it's trendless. The ADX is a trend indicator. What's the strength of the trend? So when the ADX is really low, like it's really low right now, you can see we've even taken out these levels through here, right in this area there. So if I put that, you can see how we've ticked underneath there. So that triangle, I think, is going to break out sooner rather than later. And we've already got a triangle on it, so we're in good shape there for whenever it does break. These forming larger triangles get frustrating because when you put a triangle on, you're buying a long call, you're buying a long put. Time decay is a double whammy in them, so you like it to break in some sort of a reasonable time frame. But it's going to do what it's going to do. And when these triangles get larger, the positive is normally when it takes longer to form, the breakout's a bit more volatile. The negative is by taking longer, time decay is ticking away. So it's a balance there. But it kind of helps offset this loss of time decay because the breakouts tend to be, as I said, a little bit more volatile, which helps recover the loss in the time decay as you go through. And so really that covers off all the stuff that I wanted to talk about. We'll go ahead and open it up to Q&A, and then as we always do during TradeFinder. We'll come back just before the end of the session with a case study idea for this week. I thought I would update you. We looked at TTD last week for a bit of a break back up, and it's trying, hasn't done it yet. I felt like this could be an area for the performance chasers. A high percentage of fund managers, based on the data, have underperformed the S&P. So there's going to be more trading going on in this year's December than in the past, I think. Oftentimes, if a money manager has already beaten the S&P, Thanksgiving holiday is it. They take the month of December off and don't even trade because they've already hit their benchmark. Where traders that haven't hit it, that's where their bonuses are tied. They have to outperform the S&P to get their bonuses, which is big money for them. And they're looking for, where can I get the best bang for my buck in December to try to get above the performance of the SPY. And I thought, with the fact that TTD had been just obliterated from 90 down to 40, more than cut in half. This could be an area for a snapback. I'm not talking about TTD taking off and running for the hills, just a little bit of a snapback, maybe back towards this 50-day moving average. Looked like we were heading there, ticking back down a little bit, but as long as we base here and hold this support line, I still think that's in play. I still think that's a possibility that occurs. But what I've noticed is what's happening is money managers seem to be really stretching the risk curve a little bit more than I thought they might. And they're looking at some higher beta stuff that maybe has ticked down a little bit. And that seems to be where some of the spikes are, where they're trying to get those performance numbers up. And so maybe this is not interesting enough to them, but we'll see. Still can be a nice trade if we get that bounce back to the 50-day moving average, and it's right here in the support area as well. So just a test of what was support being resistant. Same thing I was talking about during the cryptos. Anyway, there's the update for TTD. We'll go ahead and open it up to questions now, Zach.
Sounds great, Rob. We'll get right into it. But before that, real quickly, I just want to highlight what you mentioned in the beginning, that you will be presenting your focus market outlook for 2026 event tomorrow. And that's going to be at 8 p.m. Eastern time. So again, that's Wednesday, December 10th, or tomorrow at 8 p.m. Eastern time. And I just put that link in the chat to register. As Rob said, if you're not able to make it live, still go ahead and register, as that will grant you the access to the recording. So we hope to see those that can make it live and look forward to interacting with you then. But if not, definitely look out for that recording. So that said, let's go into the first question here from Mike. Is going to be on JEPQ.
JEPQ. So JP Morgan's NASDAQ, one of their ETFs. Don't know exactly what securities are in here, but that chart looks awfully similar to the NASDAQ. So I imagine it follows it pretty closely. And when you take a look at the pattern here, it does not have an LA wave pattern, which is interesting. So that means it's in a corrective phase. So all these zigzags that have happened on the way up are still in play here. We're still zigging and zagging our way to the top. We did get a bullish 1030 cross right there, moving back to the upside. So it looks pretty similar to just the chart of the Qs. It may be a little bit higher than where the Qs are, a little closer to those recent highs from the end of October. And maybe this leads the Qs a bit and moves a little bit higher. So this one might be a good one to follow if you like the NASDAQ for continuing to potentially break the resistance and move up. Yeah, it's a little bit ahead of where the Qs are, but same thing, consolidating here underneath resistance. So with this, that's 59. You won't see a break of that 59 level with an indication of follow through or confirmation and then who knows how high it could go. We can look at there's so many zigzags here. We could take the rest of the session, which I don't want to do, but we could on where all these zigzags are. On that one, we barely held that 78.6% level there. You can see right about a 79% correction, but made it by the hair of its chinny chin, if you will, for a potential move up, which could take it above 60, up near 60 and a half. But first things first, it's got to break 59 first. So, yeah, we'll keep an eye on that one. It's not quite as volatile. You can see over here on the scaling, even as I scale it down, it's still only 2.5 points between these blocks here. And then if we bring it down even more, you can see that it doesn't move as much as it appears that it does. So if you want something that has a little less volatility to it, maybe than the cues themselves, again, another reason why that one may make sense.
Thanks, Rob. And this is in regards to the rate cut tomorrow. General question from Phil. Mr. Roy, I'm wondering if tomorrow's rate cut is going to be a buy of the rumor, sell the news event, since the majority of people feel that another pause is coming after this cut.
You're right. That is what people feel, and that's a viable question. We'll have to wait and see how the market reacts to it, because with where we are on all these markets, except the IWM did technically break, but it's barely to a new high. This could also be a double top in the markets. And there's no guarantee just because we're going through nice consolidation here that we are going to break and run. We could move back down. I think we're going to have to watch the bond market closely and different maturities on the bond market, because even if the Fed doesn't cut, injecting liquidity can actually be more beneficial for markets moving higher as rate cuts and rate hikes affect banks' overnight lending. It's not a direct effect to the consumer. It takes a while for it to work its way through to where banks, cut rates a little bit and make less restrictions on lending, et cetera, which does help the consumer. It's the liquidity that the Fed can inject through various vehicles that they have that can be a quicker effect to the consumer. So we'll see. It's a viable question. I really have no idea. I think the rate cut is already priced in. I think the hawkish stance is already priced in. I think we have to see behind the scenes what the Fed continues to do, if they continue to do liquidity injections. Like I said, there was a quick tick up and then they pulled it right back. So they bought some stuff and let some more stuff roll off. And maybe that was just a timing thing on the liquidity chart that the data scientists at Hub provide for us each week. So yeah, we're just going to have to, I think we follow liquidity. And I didn't really fully answer your question, but I don't know that anybody knows the answer to that. If I can, well, I'll tell you this: if the Fed does have a hawkish cut, and the Fed doesn't inject liquidity, yeah, I think it's a buy the rumor, sell the news. So, but I think we need to keep an eye on liquidity.
Well said. And yeah, without a crystal ball, I think that's the best analysis that can be given. From there, let's go over to GOOG for Will.
Goog. Well, you're trying to trick me, Zach. So the regular Goog, huh? Okay. Is a lot of you know this is my favorite stock to trade from an Elliott Wave standpoint. It's been my number one stock since I started trading Elliott Wave back in 2001, because it does such an amazing job of following Elliott Wave patterns. Nothing's 100%, nothing's fully accurate, but I found, just my personal experience has been that this one's follows the rules pretty darn closely. So expanding triangle here, we've broken out, we're consolidating. So this is one of those three ways you can break out. Expanding triangles break out just like the condensing ones do. So expansion, contraction, depending on which way the point is. So it's still the same thing. These just don't show up as often, so they don't get talked about as much as consolidating triangles do. But they still break out the same way. So we're testing the upward breakout and 325 clearly resistance here on the Goog. And if we can break that, yeah, I think that wave three continues to run, especially since the algorithm is not sure that wave three is done yet. I think this is a good one to keep an eye on. I'm watching it really closely. And yeah, I think we could have something really going in Google if we can break 325. We do have during this consolidation, but that's to be expected. The two directional indicators, the positive coming down, and the negative ticking up a little bit, but a little tick down today on a little bounce in Google. This could immediately reverse. The directional indicators are way more sensitive to day-to-day price action than the ADX is. The ADX takes a while. So that's why they combine those two, or Wells Wilder did when he created this indicator. But it's still supportive because the positive directional indicator is still above the negative. The ADX is in the 40 area. You can see that it can go higher. It got above 50 back in the move in September. It could do that again. So what we would want to see ideally, though, is this positive directional indicator turn back up and get back above the ADX, which I think it will if we can break 325. So yeah, I think that's a good one to watch.
And another good one's going to be B for Barrick Gold.
Yeah, if gold resumes after this big spike up in silver, it's leadership, then that could continue higher. It bumped its head right there at the 61.8% extension, but we got a little bit vertical here. Again, a nice consolidation. So I think you stay long this. If you're long right now, you want to see it hold 40, because if it breaks below 40, then it gets a little dicey because of this speed in which it broke up from 30. So if it breaks below 40, we could see a move back down here to 35, which would be the first level of support rather quickly. Yeah, and again, I think it's going to depend on what happens. The miners have been falling. They don't have to. As long as the price stays elevated, you would think the miners can still make money regardless of the fluctuation of the price of the underlying metal. But they've been tending to follow the charts pretty closely. And with gold ticking up and this holding support here, even forming a small. But remember, Elliot always said, don't diss the small triangles. Don't forget about those. It doesn't have to be a big triangle to yield a breakout. The little ones break out too. Just obviously they don't have as far to go on a breakout. But yeah, I mean, this is almost one where, oftentimes I do the conservative versus aggressive approach. We all have different risk tolerances. You know what yours are. Stay in your lane, so to speak. Trade within your own risk tolerances. But if you were more inclined to take risk, then this is one I think you could take a shot at here because your stop is real quick, and that's what I like. If you're using some of your allocated money to trade riskier stuff, then you want to find chart setups like this to where, okay, it's not a clear signal to enter yet, but I can catch more of the move if I'm right. And if I'm wrong, it's a quick out. So does that make sense? So if you're going to trade something that's a little riskier because of the fact that we don't have all the indicators that we would like confirming the move yet, but yet it could happen, you want to know I can get out quick if it shows that that move is not going to happen and we're likely to go the other way. So I think this setup is really good for that. So I'll leave it at that.
Next up, we have QBTS.
Yeah, I figured that one was coming. Man, these quantum stocks are all, yeah, man, they move all over the place. And, there's, this is in the retail market, right? All the big companies are saying, yep, quantum is in the future, but it's way off. It's going to take some time before the transition there. But retail traders love, I guess it's the volatility that they love in here. Well, you have to be real careful of here. you probably can see it, is that similar pattern that I was showing on TLT, which is a possible head and shoulders pattern. Now, this one's not as classically formed as that one was on TLT, but it's still kind of there, and close enough to garner attention, I think, with the question being, are we forming the right shoulder here? And if we are, then we're going to roll over and head back down, and we're probably coming at least to 25 with the possibility of coming down even further. I can take that off now from that channel, and we would be looking for a potential move down here towards forming a neckline. And then if we broke that, well, then we would be looking for some sort of a further move here. So we need to break that indication that this could be a right shoulder. And we have the chance to do that because the wave 4 is right at 61.8. So it may just, because you can have a pattern where you do this, you have the vertical move, those don't hold. Well, it goes vertically up, comes vertically back down, which it did. And maybe now we're just saying, all right, enough of this nonsense. Let's just make a more 45-degree angle-ish move to the upside in the wave 5. So this wouldn't be one where maybe you take away that the risk one. I think this is a little more of the Missouri thing. Let's let it show us because we're going to have plenty of room. Let's let it break 30 so that it takes away the question of a head and shoulders pattern. Let's let it break 30. There's going to be plenty of room to run if it does. People will jump back in. And I'd like to see that 1030 cross materialize first as well. See, we had the bearish cross here and we continued lower. If we can reverse that and get a bullish cross back to the upside, especially with the 50-day moving average being there as well, then we may have something. I think there's plenty of room for this to run if it breaks 30. I just think you want to be a little more conservative on this one, play the less aggressive approach, and let's let it show us that we can break that 30 level, take any sort of concern over head and shoulders out of the way, and then trade it and let it run.
Thanks, Rob. From there, let's head to SoFi.
And we haven't looked at that one in a while. SoFi had underperformed for quite some time, and then it got its act together. And then recently, as you can see, has been consolidating. The problem is we're below the 10-day moving average here. We do have another wave 4. See, we had this zigzag that went all the way right to its 161.8% level here. So we got the extended C wave. We had a 50% B wave correction, went up to 100%, came back down, and then ran up. Classic rules. Oftentimes, you test a previous fib level after you hit the expected level, which is 100%, and it holds. If it holds, then you look for that extension. So move to the next fib level. So textbook zigzag Fibonacci stuff here on SoFi. We came all the way back down. The other rule is when the C wave ends, you retrace the C wave. So when the C wave ends on a zigzag, you're normally going to come back and retrace that. Exactly what happened. So it came back down to the B, held, and it's moving higher, but really want to see it back above that 10-day moving average. See, we're flirting with getting a bearish 1030 cross there. You would think that because these financials tend to do better in an easing cycle than in a hiking cycle. When we look at that, you would think that should keep a bid underneath it. But is this expectation of a hawkish cut kind of slowing down this potential wave 5? It's still in an area where it could work just fine and continue higher. But let's let it get at least back above the 10-day moving average first. And even before it gets there, it's got to break above the 50. So another one where let's wait a little bit here before jumping in to see if We could even come down and test this wave four until it can show us a move back above the 50-day and back above the 10-day. So a little bit of a pause on that one, I think, right now.
Thanks, Rob. We got time for two more before heading over to the case study consideration.
Sounds good.
All right. First one's going to be JPM.
Well, we looked at another one of the JP Morgan ETFs that match the Nasdaq. Now let's look at JPM itself. And it's kind of the same thing. So we've got two financials back to back here. Same rules. Normally in this kind of a where you're easing versus tightening, we move higher. But it seems like from this move here, moving into the uh, expected rate cut tomorrow, that hawkish stance thing has kind of taken a little bit of steam out of the move. And with this one being at a wave five, didn't quite make the tap box yet, so we could have some further extension here on the wave five. But this channel here is the key between 300 and 310, I think, on JP Morgan. We want to see it break above this level here. It's a little bit above 310, almost 320. So 318 or so. We want it to break back above that, and today's action is not what you're looking for from that scenario. Now we have to look for a potential test back down to 300, and can that hold? And if we get back down there, if we bounce again, then we can revisit it. For now, I think this is another wait and see. That channel there is really strong support resistance in there, and we need to see a break of one of those to get a better idea of where we're going from here.
And for the last symbol, let's go to ENSC.
Incise Biosciences. Man, these things, they just, they're so volatile. They're so hard to trade. You see one that goes sideways for so long, then it looks like we're off and running. And you really got to do your research on these. What do they have going on? What are they working on? What stage are they in of development? What's the likely outcome? And then you can still get unexpected successes and failures out of these and get exaggerated moves. For now, right now, just at this moment, and again, it's all we can do in technical analysis is analyze the data we have at that moment. We are a bit oversold with today's move lower. Don't know what the news was, haven't done any research on it, but we might get at least a quick bounce back to $1.50. That's where support was that broke today. We should come back and test that, especially being the fact that we're now below the 10-day moving average a bit here. So a little bit of a quick snap back towards that resistance level at $1.50. That'll probably meet the 10-day moving average there. But after that, I think you have to be real careful because it could just test that and then reverse back down. If it tests that and the resistance holds, then we're headed lower. So maybe a little more to the upside here towards that $1.50 level. But after that, I think you have to be really careful. All right, so let's go ahead and move over. We are going to borrow one from the AI signals from the Hub organization here for the stock symbol GFS. You can see he's having a good day today as well, but there's still a little bit of room to run. The negative is it's a little vertical, but it's not straight up. So it's a higher degree than 45, that's for sure. But it does look like this could continue its momentum at least up to the target. It's got a pretty solid score here. It's 78% chance that it makes it to 42. And then if we look at the DMI, it's extremely supportive of that continued move. A little bit above the 10-day moving average, so maybe we have a sideways day or two. But the way these signals work, if you try to be too cautious and say, it's a little bit overbought, I want to wait and see if it comes back down. But these signals come out with such momentum runs that we can extend a little more before we get that retracement back to the 10-day moving average, and then we end up missing the move. So what I've been talking about is if you want to trade these, then put on a smaller position. Whatever, you should have a consistent amount of risk. That's just good, prudent risk management, portfolio management in each trade that you put out. And so maybe you put on a position, but not quite as much at risk as you would normally do. And if it continues up, at least you're in it and you make something. If it pulls back down, then you can DCA, you can add some more in and get it up to your full risk tolerance for a position for the subsequent expected move higher. So I think that's the best way to trade these. So that would be my thought. So that's going to be at GFS, uh, Global Foundries, with a move up to 42.
Sounds good, Rob. Is this going to be an official idea, or are we just doing a post this week?
It'll be an official idea.
All right, very well. I will take over the screen real quick then here. All right, should be up now at the menu view of the platform. So we'll go over to this right toolbar up here at the light bulb for ideas. As Rob said, this is going to be an official idea. So as the list populates of this ever-growing community, we will click on the new idea to create an official idea. This is going to be for GFS. As Rob said, we're looking for a price target of 42. And what was the time frame we were going for?
We can just stay with that standard 3 months.
3 months. So we'll go a quarter out. And as always, we will come back and add some more detail to make this look a lot better right after the session concludes. But I am going to go ahead and post this idea. So as you can see, it's now available for you to come in and interact with. For those that have been around for some time, you've heard me say this over and over, but for anyone that might be new, I feel like it's always worth mentioning that opposing opinions is what makes markets. If everyone agreed, if it was an all buyers or an all sellers market, there'd be no transactions. Therefore, there would be no open interest or liquidity, as there would be no transactions to take advantage of. There always has to be an agreeing and disagreeing, or a buying and selling, if you will. So regardless of your opinion, we encourage you to share it. Just obviously being considerate and courteous of the community, which I think the Hub community has done an astounding job at so far in regards to just everyone being able to intellectually share discourse without, just picking on one another for, aimless attention and stuff like that. It's a very high conduct, I guess is what I'm trying to allude to here. So again, we encourage you to interact whether you agree or disagree with the idea. As you can see, when you click in, you have that availability up here at the right side. And other than that, I think that wraps up my soapbox. So I'll pass back over to you, Rob, and I'll drop that link to register for Rob's event tomorrow night in the chat one more time.
Sounds great. Good job, Zach. And bring it back to the screen. So that's what we're looking at for this week's case study. Yes, furthering that comment, unlike some of the other commentary platforms, doesn't seem to be the trolls or haters on the social media aspect of this. Everybody's pretty respectful, and that's great. And it is a wonderful learning tool to put an idea out there and see what others think, because we can do our analysis, we can come up with our reasoning, what we're looking at and why. But you never know, somebody may come up with something that we haven't thought of. So, it's just a great community, adding people every day. And so hopefully you all participate, adding people to it every single day. Hub sends me the notifications, as I've mentioned before. With that, thanks for spending some of your Tuesday afternoon with us. All eyes on the Fed tomorrow, and hopefully I'll see you all in tomorrow night's event at 8 p.m. Have a great afternoon. Look forward to talking again